We're proud to welcome you to the Exceptional Advisor podcast series brought to you by the Investments and Wealth Institute. Hi, I'm your host, Bob Powell. The goal of this series is to help you better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. This episode is brought to you by the Investments and Wealth Institute, and my guest today is Moe Allain, Retirement Advisor at Baird Retirement Management. So, Moe, let's turn our attention to your clients. How are they doing?
Bob, that's a really good question. As I mentioned, we deal primarily with retirees and pre-retirees. We look at controlling risk as our number one job. Then we look at getting a return or investing for the upside as our number two job. Our clients are doing well, and there's been a little bit of confusion. Situations have oftentimes changed as well as a result of the pandemic. Things like no longer being an empty nester, premature retirements, people actually getting COVID-19. Let me elaborate on this a little bit more. We knew that we were going to have to educate and re-educate the client on the paradigm shift in thinking that would be needed to go from the accumulation mode to the distribution mode of retirement. This is one of the hardest ideas that people have to grasp about transitioning into retirement. So we're constantly reminding them that accumulation planning is more linear in nature, while distribution planning more closely following chaos theory. Again, thank you to Jim Sandage and his articles. So recently, with the Institute focus on retirement income strategies, modern retirement portfolio theory, the efficient income frontier, the presentation put it nicely by saying that modern portfolio theory was widely supported for portfolio construction during accumulation, but it was insufficient in retirement distribution. So we communicate that distribution planning is different, that we first got to build the floor and then worry about investing for the upside. So the first thing that we do when we receive new client assets is we build their income reservoir or paycheck generator. That's what we call it. The income reservoir is going to consist of at least 10 years worth of living expenses, and it serves the purpose of the income floor. The composition of that income reservoir is going to be short to intermediate term investment grade corporates and governments. Because we build the income reservoir from the start, a fairly new retiree could have had as much as 90 to 100% of their portfolio in the income reservoir before the market sold off. Few of our clients have less than 60% in their income reservoir, but most have more than 60%. So our clients did very well. As a matter of fact, we started discovering that because they had done so well, many of them thought that something was wrong with their statements, and they just didn't want to say anything about it. It's almost as if the performance was going to get taken away from them if they had mentioned something about it. So their fixed income was now performing almost like conservative equities. So again, first we built the floor, then we invested for the upside. The other thing that we typically do is we dollar cost average into equities. So a new retiree in January of 2020 might have had only 2 to 4 months worth of equity investments, that were scheduled to go over an 18-month period of time. So we use a 30 to 40% equity target range. That's our bumper guards as taken from the retirement policy statement. So since we're doing this dollar cost averaging, we're able to control the risk by being able to stop, accelerate, or decelerate this dollar cost averaging process into equities for our clients, and we can choose to add to their risk budget or not. Some clients wanted to accelerate the dollar cost averaging into the March dip. Others chose to temporarily pause the dollar cost averaging until the smoke cleared, but most of them simply stayed on track with the existing dollar cost averaging schedule. Where clients were a little bit confused was with the disconnect between the S&P 500 and the NASDAQ. We had to help them understand that 25% of the S&P 500 was composed of those less than 12 stay-at-home stocks that just performed great during the pandemic, and help them to understand that if you took those 12 stocks out of the S&P 500, its return would actually be negative. And that would more closely reflect what was really happening in Main Street, USA. So since the media has had a tendency to focus on these FANG plus stay-at-home stocks, not much else, this was a really important thing for us to make sure that our clients understood.
So obviously, here we are, we're still in the middle of the COVID-19 pandemic. Have you made any specific adjustments to your clients' investment financial retirement plans because of the pandemic, because of the market volatility, or because of falling interest rates or low interest rates?
That's a good question as well, Bob. Of course, it's going to depend upon how new the client is to retirement. So we've been constantly reassessing their liquidity needs, risk appetite, changes in their financial goals or household situations, and rerunning their Monte Carlo simulations to incorporate any of those changes, both for the remainder of 2020 and into 2021. We've encouraged many clients who still had mortgages to refinance at a much lower rate during the pandemic if they could simultaneously increase their equity, reduce the time to pay off, reduce their monthly cash outflow, net of all-in expenses. We've then remodeled this in their plans and seen nice improvements here. Because healthcare is so important, especially as many people have lost jobs, we've also refined the actual retiree medical cost specific to the company they worked for. And if they were over 65, any out-of-pocket Medicare or supplement costs into the client plans, rerunning the Monte Carlo simulation so they can see those as well. We've also begun to run a lot more annuity hypotheticals and illustrations, looking at potentially adding part of this, to their nest egg with the purpose of making sure that they had a solid income floor in the portfolio.
So obviously, this period of COVID-19 has created a lot of anxiety. Have you had to think about the use of behavioral finance theories as you think about protecting your clients against whatever cognitive biases they have or had?
Absolutely. The non-numeric part of financial and retirement planning is at least 50% of the value that we provide as advisors. The pandemic has brought out many biases like loss aversion, availability bias, herding behavior, confirmation bias, and overconfidence bias. A big part of my job is preventing the client from hurting themselves. So I'm also very well trained to navigate through these uncertain times that we're currently faced with. As I explain to clients frequently, I'm the expert at what I do. They're the expert at what they do. For instance, attorney, engineer, etc. They oftentimes will need these reminders. Keeping clients focused on the big picture and sticking to what you can control, especially for newer clients and retirees, has been really important. Helping the clients to understand that we're all anxious about the pandemic in the future. But as human beings, we're very social animals. So we want to know what's going on, but with all of the information being constantly disseminated about the pandemic and the upcoming election, they can't possibly sift through it all and come up with the answers. That will drive them crazy, and probably their spouse also crazy. So minimizing the news that they watch was a good place to start in trying to keep everyone mentally healthy and focused more on themselves than everyone else. I've offered to clients the following. If they wake up in the middle of the night thinking about something they wanted to talk with me about, go ahead and send me an email or a LinkedIn note at 1 a.m. I'll be more than happy to return that email or LinkedIn note the next morning when I get into the office. That normally puts them at ease, and I seldomly get those kinds of emails or LinkedIn notes anymore. In March 2020, the coronavirus market drop caused many people to want to rush to the sidelines with cash so as not to impact their paychecks they are taking from their retirement nest eggs. I remember the same thing happening back in the 2008 to 2009 financial crisis. Also during the pandemic, these FANG Plus stocks started doing really, really well. And clients would ask, should we buy Amazon, Google, Tesla, or Netflix?
Right.
So helping clients to understand what was happening in the markets and with their retirement nest egg was critical. We went back to the planning basics of blocking and tackling. We reviewed their own personal goals and asked the question, has something all of a sudden changed for them? We reviewed their asset allocation, their risk tolerance, and their remaining risk budget, their liquidity, and the household spending. Since our process and our methods don't take their paychecks from the equity when it's down anyway, but rather we take their living expenses from the bonds, which have been up, there wouldn't be any change to their paychecks at all, and no reason to abandon stocks because we were still within our bumper guard range of 30 to 40%. And we had plenty of floor left. So reminding them that adding money to these FANG plus stocks would add a significant amount of volatility and standard deviation to their risk budget, help them to understand that that's probably not something that we wanted to do. Now, here's an analogy that I use that has helped very frequently with clients. I like to use the analogy when clients come in and they ask me, okay, they ask, I saw Susie Orman on TV last week. Now, Bob, I'm not picking on Susie. I've read every single one of Susie's books, and I think she's great. But this is what they'll say. They'll say, I heard Susie Orman say that I shouldn't be in any bonds. Should we get out of all our bonds is what the client asked. So I asked the following: when did you meet with Susie Orman? The client says, well, I haven't met Susie Orman. Okay. Then I ask, well, when did you provide Susie with all of your financial information, as well as your liquidity needs, risk profile, investing experience, and financial retirement goals? The client again says, well, I haven't provided her with any of this information. So then I'll ask, okay, so what kind of bonds did Susie say you shouldn't be in? And they'll say, well, I don't remember. So then I'll finish up by saying, just to make sure I understand, you want to make a major change in your retirement portfolio suggested to you by someone you've never met, doesn't know you, and knows nothing about you financially. And then the response is always the same: crickets. I'll then point out that oftentimes general comments will be made in the media that have absolutely nothing to do with the client's specific situation. Yeah. So they should always keep that in mind. I then remind them that I probably know more about them financially than maybe any other person alive, and am in a very good position to help them to meet their financial goals and help them to navigate through retirement successfully. Normally, I only have to make that analogy one time and the client gets it.
Yeah. Moe, so much wisdom, and so my next question is about sharing some of that wisdom. What advice might you have for younger advisors who are grappling and with how to deal with their clients in the midst of this pandemic, and who may be experiencing this kind of need for the first time in their careers?
Well, Bob, clients are human just like you and I. Most of them are anxious right now, and probably many of them are worried. Uncertainty simply does this to us. I would say that make sure to not forget that family is the most important thing. Make sure that you know what's happening with the entire client's family household. I mean, many empty nesters are no longer empty. People have lost jobs. There have been premature retirements, and lots of other changes during the pandemic may have impacted the family. Things are tough out there. Know your client, KYC. Do some pre-call planning before you make the call or send the email by looking at your previous notes. Keep in frequent contact with them, even if it's just a 2-minute phone call, to let them know that you were checking on them. Keep the life story of the client moving forward. Let them know that you are there to help make sure that those life and financial goals stay on track and that their story continues on. If the advisor is in a building your practice mode, don't assume that the middle of an uncertain pandemic is a bad time to prospect. I'm thinking actually it's a really good time to be talking to future prospective clients. Don't reinvent the wheel. There are plenty of older advisors in this business. If you haven't already done so, consider reaching out to one of those advisors that's already been through the 2000 to 2002 and 2008 to 2009 market timeframes with their clients and ask them, what did they do right? What did they do wrong? Learn from someone who's already gone through a difficult period with their clients. And of course, most importantly, adding on additional certifications like the RMA can help your clients feel even more comfortable. Let them know that you're gaining this additional training for their benefit.
So as you reflect on what you've done over the past 5-6 months during the COVID pandemic, what activities do you regard as best practices, and what of those activities have you adopted in your practice?
Again, Bob, you're full of so many good questions. I personally have had 3 clients get coronavirus. One of them almost died. I also had a client couple get quarantined in an assisted living facility that became a supercell of COVID-19 infections. They couldn't get out, and no one, including family, couldn't get in. I called them every week to check on them until things opened up again. So this pandemic is very real and happening. Almost everyone I talk with knows of someone that's been directly impacted. Entire households are being impacted going beyond the client themselves. As investor demand for client communications during COVID-19 has jumped over 50%, I'd say you better be communicating with your clients. I think that the client is the primary driver of the frequency of contact from us, but I also believe that whatever frequency of contact we had pre-pandemic has to definitely increase. The old, I'm going to sort my book by my A, B, and C clients and put together a communication protocol from that may need to be revisited. Non-investment related check-in and personal phone calls increasing are a must. Just give them a call and ask, is everyone in your family okay, safe, and well? Don't overcomplicate this. I personally like using the combination of regular check-in phone calls, emails, WebExes, and LinkedIn notes to stay connected with current and future prospective clients. We're also providing clients with tutorials on making a video call or using LinkedIn to send messages if they seem hesitant or afraid. Will come right out and ask us to teach them these things. You've got to be ready to wear the advisor, preacher, teacher, coach, cheerleader, or psychologist hats at any time your client needs you to wear that particular hat. It's a new day, and these times are different than at any other time in our history. There is no precedent. If you're not providing your clients with the strength, stability, and perspective in the months ahead they yearn for, your competitors will.
So Mo, last question, if you don't mind, is what have you learned about your business, your practice, yourself, your clients during this period?
You know, it's certainly been an interesting period. I can tell you that advisors can get anxious about a crisis like the pandemic too. Although I've been in the industry through both the 2000 to 2002 and 2008 to 2009 timeframes, I've had to come to terms with the idea that I wasn't going to be able to achieve certain business and personal goals I had set for 2020, primarily because of the pandemic. Bob, I didn't like that realization. I realized that I just had to pivot like any good running back and reset those goals, making sure to keep moving forward. Working from home versus working from our regular office has its pros and cons. I'm in my third week of working back in the office as part of a pilot group. I believe the future advisor may look like a hybrid between the two, meaning the importance of appropriate technology and connections working from home going forward will be very important and maybe a need, not a want. During the pandemic, even some of our most formally educated and important clients, normally what I might call our smartest and bravest clients, have had anxieties and become worried. They've just melted during the pandemic. We had to talk to them more frequently. You've got to be in charge for your clients. Whether you're working from home or back at the office, you need to have a structure and a process in place. I've really been surprised by the number of people that haven't opened up the reviews I've sent them ahead of time before we had WebEx calls. When I asked them why they didn't look at things, they often responded that they didn't want to look, thinking it would be bad, when in actuality, they were doing much, much better than they thought, and even doing better than many of their friends and neighbors.
So Mo, before we wrap up, is there anything that we haven't touched upon that you'd like to make mention of, or anything that you've already discussed that you'd like to reemphasize?
You know, what I would tell other advisors out there is this: after going through crisis periods of time like this, it's a really good time to consider additional certifications. That will be very much a confidence booster. It will help you to probably add assets to your practice. It will help you to do a better job with your clients. You'll feel better about what you're doing. And overall, your entire life will probably turn around. So get additional certifications like the RMA and the CPWA. Don't wait.
Well, I can't tell you how much I've enjoyed our chat today, and how I'm certain that many advisors who listen to this will be helped by it. So I much appreciate the opportunity to chat with you.
Always a pleasure, Bob.
Thank you.
Take good care.
Thank you for listening to this episode of the Exceptional Advisor podcast series. This episode is brought to you by the Investments and Wealth Institute. This episode features a certified private wealth advisor and a retirement management advisor professional. Both the CPWA and RMA certifications are advanced professional credentials for advisors seeking to expand their skills and provide added value for their clients. To learn more about these designations and the value they can bring to your practice, visit www.investmentsandwealth.org/get certified. Stay up to date and have the latest episode delivered straight to you by subscribing through iTunes, Spotify, or wherever you get your podcasts. The Institute stands ready to help you as you navigate these turbulent times with new resources, research, programs, accommodations for candidates, and certificates. For more details on resources available, visit www.investmentsandwealth.org.